Good afternoon, everyone. It's Thursday, December 31st, 2009. The market's closed for the day, the week, the month, and the year. And what an amazing year it's been. I mean, if you look back at where we started this year with a real sharp decline right at the beginning of the year, most people would not have guessed it was going to end up being 23.5%. That is the S&P 500. The semiconductors up 58% for the year. The Qs, the Nasdaq 100, up 53%. On this list, I have the UUP, which is the dollar index, which was down, and you see correspondingly gold was up 24%. Anyways, I'll have those numbers posted. Let's take a look at today's action as well as a little bit of a review of the year as well. The S&P 500 did close below the level that we've been looking at as support. That is the previous breakout range here, 111.80 to 112. So that kind of puts us on a little bit of a nervous footing here to start out the year. And takes into consideration, we have to now take into consideration that this is a failed breakout here at what has been the 50% retracement level and the area of that trend line that we've seen connecting the 2007 highs, 2008 highs in the S&P 500. I didn't draw that perfectly, but this has been an area of contention here for the last month. And if we look back at the range of the market this year, this month has been actually the smallest range, with a 3.6% range in the S&P 500. That's this month versus ranges as high as 21% back in March of the year. I'll post that a little bit later as well. But when we look at this S&P 500, again, the market started with a horrible decline at the beginning of the year. If you actually look back at the first few days of the year, what you'll see is that it started out strong, and then we had seen that the sellers came in quickly. So after about 2 or 3 days of that initial strength here, they got us past a little bit of resistance. The problem with that was, though, we still had a declining 50-day moving average, and that put us at the beginning of the year on a little bit of caution with that breakout. And again, it's not always just breakouts that matter so much, it's the subsequent action. Can the market hold on to the gains? Well, this action right here could be what we're seeing develop right now at this 112 level. That is, that we've seen the breakout past that range. That failed to hold. Now it could lead to a bigger decline. Now, I don't want to predict that yet. We have to get more evidence from the market. But instead, let's just take a look back at where we started this year again. And we can see that, starting it out, we had seen that failed break here on the S&P 500, a quick move lower in January that tried to recover a little bit. February was a horrible month, and we bottomed out in March on some big fear, really. It tricked a lot of people, myself included, in there, because we didn't get what would normally be considered capitulative volume, kind of similar to the November of '08 lows. That it would have been nicer back there, just in hindsight, to see heavier volume. Anyways, the market did reverse. Obviously, we got it back above its 10, 20, 50-day moving averages, and then when we look at the at this daily time frame, what we start to see develop was this head and shoulders pattern with the neckline kind of coincident with the 200-day moving average. So we had seen the initial break beyond the 200-day moving average, and then a pullback where we had seen lower highs and lower lows with a declining 200-day moving average. Then the market was able to take out this high right here at about 95. Now let's look at the weekly time frame to see the significance of that 95 level, because when we look in here at the S&P 500, here's this 95 level right in here, and this is where we had that higher high. At that point, we also had the 10-week above the 20, above the 30, and that 30-week just crossing up through the 40-week moving average, or the 200-day, and the 200-day was beginning to flatten out. This is where, in my mind, officially the bull market began. That doesn't mean that was the low, obviously, but this is where you can point to it and say, okay, we have higher highs and higher lows. We've taken out significant resistance, and we have that 200-day moving average that's held as support. Now, that's where the bull began on a weekly time frame. It's going to take a while for it to end, similar to what it did over here. What we need to see for for this bull market to really roll over and die is for it back below all these declining moving averages and lower highs and lower lows. Now, that's on the weekly time frame, not to be confused with what we're seeing on a daily time frame, because on a daily time frame, obviously things can get worse in a hurry before they start to develop, or that is show up on the weekly time frames. So now I think that, early this year, coming into this year, we're going to want to keep an eye on this bigger level of support down near 108. Breaking that would, I think, get a lot of people nervous and might be the catalyst for a sharper pullback, perhaps that's met with the rising 200-day or 40-week moving average. Right now that's about 103 or so, and we had, that 103 level had been a prior level of important support this year. So, all in all, obviously we've had a volatile year. We started out with this huge decline and then just a massive rally. A lot of people have been looking for the top the whole way up. They've been looking at things like trend lines, like Fibonacci, that people were looking at the 38.2% retracement near 102 and saying this is where the market ought to roll over and die. We also remember that we had that head and shoulders pattern back in setting up back in June, July, May, June, and July, right in here, and this is where a lot of people really got trapped as well. We had seen this textbook head and shoulders pattern, and we had seen the break of the neckline. That got a lot of people short in there. What we always have to remember whenever we have a breakout or a breakdown, similar to again what we saw at the beginning of the year with this breakout. A breakout is one thing, it's the follow through that matters, and when they fail, they can fail quickly and lead to very large moves in the opposite direction, because you get a large group of participants leaning in one direction. In this case, January 1st, 2nd, 3rd of 2009, people were optimistic. The calendar changed and they thought, hey, it's a new year, it's a new market. It's not a new market. We still have the trends intact from the prior year and the prior pressure from the longer term trends, which were still lower in early 2009, obviously. It's a slow transition. And then when we had this obvious breakdown of that head and shoulders pattern, what we saw happen in there was that it became so obvious and so widely talked about that it failed, and then if you stuck with your shorts here, you were going to get run over very quickly, instead, because the market reversed very quickly once again in there. So now we have to be on the alert, or going into the beginning of 2010, that this is a failed breakout to the upside that we've experienced over the last week or so. People have been saying, well, it's on light volume, and it has been on light volume, and I've been pretty adamant about saying, trust it though until price breaks down. And what we've seen today at the end of the day was price did break down. Now, if 112 starts to act as resistance and we see lower highs and lower lows, it means we have to start the year with a slight bearish bias in the intermediate term time frame within the context of a much larger bull market here on the weekly time frame. So it can be confusing looking at multiple time frames, and what you want to do is figure out which time frame makes the most sense for you. To a longer term investor who's making their decisions based on a weekly time frame, this sell-off at the end of the day is meaningless. To a day trader who is sitting there at his machine watching the action below today's daily VWAP and then it breaks support right in the close, this is a hell of a way to finish your year with a real nice short sale if you're a trend trader on the 1 minute time frame, because the trend was lower, it was below the daily VWAP. So going into 2010, what you have to remember is the market's volatile. It's volatile every single year. Where it's going to end up 1 year from today is really only relevant based on these comparisons that people like to make. It really means nothing. What you need to focus on is making the right actions day in and day out, and the decisions based on how you view risk, how much time you're willing to commit to holding an idea, how much capital you put into it, and riding the trends as they tell you to. And when the market tells you that the conditions are changing, to start to get defensive, wait for the market to give you the entry signals, and repeat that over and over again. Realistically, it's just always a trader's market, and that's the beauty of it. We hear about the last 10 years the market's basically done nothing. Well, realistically, for an investor maybe, but we've had two fantastic, and this we can count it as the third fantastic bull market in the last, let's just call it 13 years, and we've had two horrible bear markets. These are generational moves realistically, and we've experienced them in in a compressed period of time, being the last 13 years or so, that we've seen three bull markets and two violent bear markets. We may see another bear market. That could be the case, but it's going to take time to develop. We're going to see some distribution before it declines. So let's take a look at some of these other markets. I'm not going to go as in depth in them, but let's take a look at the Nasdaq, because the Nasdaq had a hell of a year as well. The Nasdaq was, the Qs, that is, were up 53.8% year to date. And same thing here is that a lot of people were looking at things, valuable tools like Fibonacci, and saying, well, that 38% retracement, that's where this rally will peter out and fail. And then they said, well, the 50%, because you can see that was prior support as well. And then the 61.8%, but there's been no resistance found. Those are inflection points. They're good levels to be aware of, but they're not a sole reason to base a decision to commit your money to the long or short side. What we want to do is we want to be aware of these things and say, okay, well, this trend line looks like, perhaps it's acting as resistance in here. But then as the market continues higher, there's just no reason to be on the short side. Those are areas where you want to look at the market on shorter term time frames and say, what's happening in here? What's the true picture of the market? And the true picture of the market is we're still showing higher highs and higher lows. So, the bigger level of importance near term, first couple weeks of 2010 rather, what am I talking about? 2010 for the Nasdaq 100 is going to be about 44.5. That's where we've seen this most recent rally develop from. We had seen and discussed this ascending triangle, the higher lows with these repeated tests of resistance, those tests becoming more frequent through time. And the market gave us a reason to think that at this point that, hey, we should be getting more bullish. And then when it breaks out, then we want to get aggressive to the long side as it starts to turn sideways. Here we have stage 2 markup, stage 3 distribution, and stage 4 now decline. We're below this support. Let's see now, is 46 going to act as resistance? If it acts as resistance, then we're going to need to see how far this market pulls back. Ideally, we want to see it hold near about 44.5. Otherwise, we may risk a deeper pullback down towards this trend line, which would be met at approximately 43 or so. But still, you have to look really only at the shortest of time frames, over the last 5 days, really, to see any evidence of selling in the Nasdaq. We're still in this fantastic bull market that's just shown relentless higher highs and higher lows and run short sellers off. There's nothing to say that the top has been reached here. There's nothing to say the top's been reached in the Russell 2000. We can look here at trend lines that may not be as relevant. We can also look at Fibonacci on the Russell 2000 and take a look at retracements in here. We had some struggle at the 50% retracement level. Perhaps this market is going to continue up towards the 2/3 retracement near 65. Well, that was a prior big level of support for the Russell. And let me go back to the S&P for a moment, because I wanted to point that out as well. That the S&P could still be headed for 123 or so. The short term doesn't suggest that, okay, but the longer term time frame is still bullish. So let's go back to the Russell. The Russell on the daily time frame, if we look there, as we know, it just recently broke past resistance at the 62.5 level, and here we are at the end of the day, at the end of the year, testing that level once again. Well, look in here closer. We have a rising 10, 20, 50-day moving average, and this is a pullback within what's been a heck of a rally here the last 6 or 7 sessions. We had 6 or 7 up sessions, followed by so far just a pullback. If we look at this pullback from where we have, let's say, just this low to this high, we're at a 38.2% correction. Not a big deal. Not a reason to be concerned. A reason for caution in the near term, but not a reason to think that this bull market has run out of steam. The semiconductors have been leading this market. They broke their downtrend line, and they've retraced more than 50%. Obviously, they've there's the trend line break. They've been pretty neutral for the last 2 quarters basically, until about a month ago, until the last month, where they broke out again and have been leading this market. We've seen all kinds of people calling for resistance at this prior support, and the resistance was temporarily found there. But markets correct two ways: they correct sideways through time, which is the more bullish way, or they correct by pulling back in price. And on these longer term time frames, when the longer term moving averages are still heading higher, from a longer term perspective, you still give it the benefit of the doubt to the buyers, just as the benefit of the doubt went to the sellers when we had that green 200-day or 40-week moving average heading lower. It's a transitional process that takes time, that starts to show up on the shorter term time frame. So if we're looking for a top on the weekly time frame, we have to see evidence that it's topping out on a daily time frame. There's zero evidence of topping out here. We're running into a little bit of resistance in this area, but we've just, we're absorbing these gains. So still, again, another, it's a healthy group, the semiconductors. We've got a trend line. We're still above the 5-day moving average. The more important level here in the first week or two of 2010 will be 2750. Breaking back below that, then, we have maybe a failed move there as well, but nothing suggesting that yet. The financials are perhaps the most hated group this year. They were up for the year, but only 15%, so they did definitely lag. And here at the end of the year, we've seen that last 6 months they've been pretty neutral, pretty tight range, maybe a 10% range. But right now, what we're seeing is we're encountering some intraday resistance at the declining 50-day moving average. That's not a good sign. We're not officially, in my mind, in a downtrend yet, because we really have to break these lows near 1380-ish or so for this market to kind of roll over. But even if that were to happen, let's just expand this a little bit. Even if we're to break that 1380 level, I think that there's the potential for bigger support to be found at this prior resistance that had plagued the market for the first 6 months of the year, near about $13 a share. So I don't think they're going to completely fall out of bed. It doesn't, the charts don't support that right now. Percentage-wise, obviously the financials were a big laggard. If you also look at from their 2007 highs to their 2009 lows, where how they performed on a relative basis, not even 38.2% retracement. So they didn't even get up to that first, what's considered important retracement level as far as Fibonacci goes. But we all know that they're troubled and they've been having that issue. Let's take a look real quick at some commodities. Look at oil. Oil in 2007, 2008 had that huge rally up and then just got completely crushed late 2008. And now it's still undergoing that healing process. In this healing process, however, we can see that there is constructive action in the USO. We have these higher lows here on the weekly time frame, and we're holding above what's now a rising 200-day or 40-week moving average. So this market, the USO, it's a choppy market for sure. I mean, we've got all kinds of crazy movements in here, which is why I don't like to trade it. But it's worth looking at from a technical perspective, obviously, because it does influence a lot of macro allocations of capital and that sort of thing in the market. But next year, if we get above 42 or so in the USO, then we could see some further resumption of this trend that is obviously higher now. The biggest disappointment, I think, to the bears in 2009 was the second shoe that was always supposed to drop, the commercial real estate. Now, commercial real estate was up 23% for the year, and you'd seen that, just like the other markets, when it really broke past the resistance and this inverted head and shoulders pattern developed with the left shoulder late last year, the head going into March lows, and then this right shoulder as it battled with that 200-day moving average. When it broke that, we had the 10-week above the 20, above the 30 and 40-week moving average. They were all starting to head higher, and that's where we started seeing these higher highs and higher lows that have been tormenting the short sellers. So, the story throughout the year was this is the second shoe, and a lot of brilliant investors, and I'm not going to name any of them because there's no value in that, but brilliant investors, much smarter than I, came out and said this is the second shoe that's going to drop. This is what's going to, lead us to the double dip bear recession and that sort of thing. But they've been rallying, and they still look like they're in a good uptrend here. We could still potentially see this market next year heading up towards 55, $60 a share. Unless what? Unless we start to break down. If we start to break down and we see all these moving averages start to decline, we're below a declining 10-day moving average, and that 10-day moving average breaks down below the 20-day moving average and the 20 below the 50, and they're all declining, similar to what we had seen, if we go back to over in here, on the left side of the chart, when we look at, and we can actually just do this, when we start to see it breaking down like this, well, then that's the time to be bearish. It's not time to be bearish when all the moving averages are heading higher, because it tells us the trend is higher. The process of a top is just that. It's a process. It's a gradual shift like we'd seen. We'd seen this big run up. It dropped. It went sideways. It broke important support. All those longer term moving averages declining. And as long as they're declining, the market's guilty till proven innocent. And now this year, and going into 2010, as long as they're advancing, innocent till proven guilty. But it doesn't mean that you don't adhere to the rules of investing and trading, which are risk management is job number one. Forget about the headlines, forget about the volume. It's good to see, volume confirm a move, but the only thing that pays is price. Let's take a look at gold real quick. Gold had a great year. Gold was up, the GLD was up 24%. We had seen it break past this resistance here, and this, what was, this symmetrical triangle, kicked that move off that did pierce, we'd seen this symmetrical triangle break, and then the market rallied up on pretty heavy volume up to these prior highs, consolidated in there, and now let's drill down to a daily time frame to take a closer look at that. And that was back in this area. These were the let's go to a different time frame here for a moment. Let me just kind of drill in a little bit better. So here was our symmetrical triangle. We had broken past that and tested these highs. Now higher highs and higher lows. We're consolidating near this 50-day moving average. I wouldn't say that gold is done. The weekly time frame, we're starting to see the volume pull back a little bit. We had seen this move get a little bit parabolic in here. I wouldn't be surprised to see a bounce up towards 115 or so. In the intermediate term, we're starting to find some support near 105-ish area. That's still not clear to me where to buy this. We're below the 20-day moving average. I think when we see, the 10, 20, and 50-day moving average kind of flat, or 10, 5, 10, and 20-day, that's what we have on the screen. The red is a 5, the blue is a 10, and the green is a 20-day. I think when that 20-day moving average flattens out, when we get the 10 and 20 rallying back up, perhaps above 108, 109, then we could head back up maybe towards about 115 or so. And then, you want to see how that, if that rally does develop, then you want to, raise your stops up underneath higher lows and get as much from it as the market tells you based on how much risk you're willing to tolerate. The US dollar was down this year, obviously. It was down 6.5%. We'd seen that here on the UUP, this is the ETF that tracks it, that basically what we have right now is this dollar has had a great rally over the last month. It was up 4%. Not a great rally, but a good rally. It's had a nice rally. We're back above the 10, 20, and 50-day moving average. The 50-day moving average is advancing, but it's coming into a declining 200-day moving average. So longer term, the trend is still lower. On the daily time frame, we're searching for some support in here. Perhaps we're going to get another pullback down towards that 50-day moving average near 22.5, and that could be the basis to create a right shoulder. We run up and test the 200-day moving average, but it's still going to take a lot of time, I think, to turn this market back around. If you look at 2007, 2008, when we were back down in these areas, what happened? Well, we had some time. We had the market correct time-wise, and we need that time correction. Otherwise, the other way to do it is it rallies back above that 200-day moving average, kind of similar to what the SP 500 did, which was rally back above. So the dollar could be here, here maybe. Maybe it rallies up, test that 200-day moving average. 200-day moving average acts as support. But again, it's going to take a while for any real longer term upward move in the dollar to take hold here. It's still going to be met with resistance. We've got these bigger levels of prior support that are likely to offer resistance on the way up. So if you're bullish on the dollar, I still think that you're early. We're probably going to see pullbacks. If you want to establish long positions, it probably wouldn't be. I wouldn't really think about it too much unless we first saw a pullback down towards 22.5 or so first. The other big disappointment to the market this year, I think, was the retail index. The retailers, the consumer was dead, everyone told us, but people still continued to refinance or whatever, and the consumer was alive. We had the same early year sell-off. We had seen this trend line develop. We've broken that trend line, and what a trend line break means is not that the market's reversing, but the rate of ascent has slowed, and it's easy to see that in here as well. We've got some important support recently near about 91.5. So we've been really in a tight range here in the retail holders over the last month or so. And breaking below 91.5, that could be the basis for a test of these other levels near about 89, and then maybe near 87. I think that 200-day moving average could come up and meet that meet prices basically at about 87. So I'd be a little bit cautious about the retail holders because they've broken that trend line. Now they're turning sideways. This is possible distribution here. We do still have the primary trend higher, so you don't want to be getting short yet, but gun to the head, I would say that be on the lookout for a break below 91.5 or so. Anyways, that was meant as a kind of an overview of 2009 and a small look forward to 2010. I hope that all of you had a great year trading and investing, and that you're going to take the time and make the commitment to learn more about the markets as I am, and I'll try to share my thoughts with you. Don't expect me to be right all the time. I'm definitely not, but objective observation of trends is what's always served me well, and I hope that 2010 is a terrific year for all of you in everything that's important to you, and for everyone who is important to you as well.